Hi, welcome back to another edition of Lippers Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. I'll be reporting estimated net flows for the conventional fund business originally, and then we'll talk about ETFs later on for the weekend of Wednesday, May 23rd, 2018. We basically saw net inflows about $3.3 billion in the group, third consecutive week we've taken in net inflows. But this is a real topsy-turvy time period. I mean, we had geopolitical issues. We still have kind of Iran issue going on. We have a Venezuela vote in Venezuela over the weekend that many people thought was illegitimate, and so we were worried about some of the gas prices going up and oil prices going up because of possible embargoes and the like being placed on Venezuela. And then we also have the on and off again trade wars, if you want to call it, the trade discussions between China and the U.S. So really it was just a topsy-turvy week. We saw yields actually go up above 3.10%. Actually, I think they hit almost 3.12% during the week as well, and I think that made a lot of people kind of back off of some of the defensive issues. So we saw real estate, utilities, any of those that were kind of related or actually get a boost out of having low yields. People reevaluated those and actually took their foot off the gas pedals for those particular pieces. But overall, we actually saw some okay returns. You know, when I'm saying okay, 0.030 to 0.48. 0.48 was actually for small caps, and small caps are getting a little bit of a tailwind pushing them along as investors are moving more towards the idea that global concerns, higher interest rates, all the rest of the stuff that's been going on, and then repatriation of money and the like, it doesn't impact them as much as it does larger cap issues. So I think people are turning their attention towards some of the smaller cap issues. And so let's go ahead and see how this panned out, the news for the week and our estimated net flows for the week as well. Let's first take a look at our macro groups, and we'll start with our equity funds. Equity funds saw about $600 million in outflows. Not a big story, but again, outflows. A little more detail coming later on. Taxable bond funds saw about $798 million of inflows. We saw that muni bond funds took in about $128 million, and money market funds were actually the main attractor of assets, of investor assets, somewhere about $3 billion, just a little bit shy of that number. Let's go ahead and take a look at the macro groups one by one. First, let's start off with equity funds. Equity funds basically saw a return of about 0.10% on average. Fourth consecutive week they've seen upside performance. But again, as I was telling you, there was $571 million in outflows. Third week in four that they've actually seen outflows, and how this panned out was domestic equity funds lost about $1.8 billion. Third week in four they've seen outflows, but they had a return of 0.43%. On the non-domestic side, as both Pat and I have been talking about for it seems like years now, non-domestic equity funds actually saw about $1.3 billion of inflows. 10th consecutive week they've taken in money, but it's the first week in four that they've had negative returns, this time to the tune of 0.53% as far as losses go. So a little bit head scratcher. People are still putting money to work, I think, on autopilot into these international and global type of funds. If we take a kind of a deeper dive, large cap funds lost about $851 million, and we saw international equity funds taking in about $1.3 billion. So it was pretty much even as far as went. I think we saw like $300 million going to emerging market funds. But basically the story was that they kept it going on the international side, so international large cap, international small cap, and the like. Well, let's go ahead now and turn our attention towards the equity ETF arena. Basically, seventh consecutive week, they've seen net new money come into the group, $4.2 billion this week, and we saw the iShares Russell 2000, as I was talking about earlier, taking the lion's share of the flows with $1.2 billion coming in. Actually, it's the biggest flows, maybe not the lion's share, but certainly the biggest flows that we saw. And then it was followed up by the iShares Core S&P 500 fund, which saw about $454 million in net inflows. iShares MSCI EFA Value Fund lost the biggest share of money. $818 million flew out of their coffers. And then we saw the iShares Real Estate Fund ETF lose about $293. Not a lot to talk about there. Well, now we can go ahead and turn our attention towards the fixed income side of the arena, see what happened there. Second consecutive week, we actually saw inflows, $798 million inflows this week. Third week in four, they've taken in net new money, and they had a return of about 0.17%. Now, the corporate investment grade debt funds actually took in about $982 million in net new money, and we saw that for the 12th consecutive week that they've been taking in money. International global debt funds also took in about $519 million, while on the bottom side of this, we saw balanced funds lose about $340 million. Corporate high yield funds also saw outflows, that to the tune of about $259 million. So a little bit of foot off the pedal as far as aggressiveness goes there. Let's go ahead and take a look at our fixed income ETF universe to see what happened in that group. About $2.3 billion in net new money came into that group, fourth consecutive week they've taken in money. And the iShares Bloomberg Barclay High Yield Bond Fund was the main attractor of assets, about $427 million. iShares iBox dollar investment grade corporate ETF took in about 424. And if we look at the bottom of the group, we saw the ProShares Ultra Short 20 plus Treasury bond ETF lose about $106 million. So despite the big spike in yields that we saw, by the end of the week on Wednesday, it actually dropped down to 2.99%, and I think closed that day at 3.01%. So really, there was not a big change from a week-to-week basis on high yields or on yields, at least at the Treasury, on Treasury, 10-year Treasury piece. But again, we are seeing, again, an increase, and it's a little bit of a head scratch that people keep putting money back into bond funds, just because there's an inverse relationship between yields going up and the value of their instrument going down. A lot of people have postulated that it's possibly due to people expecting a slow and steady Fed increase, and they certainly got a patient Fed, a kind of a dovish Fed comment this week after the May 2nd minutes came out, and it doesn't look like that they're absolutely going to have a fourth 25 basis point rate hike, and maybe are comfortable just taking a slow and steady approach, and that does favor fixed income instruments. Let's go ahead and take a look at our last of fixed income instruments, and that is actually at Muni bond funds. Muni bond funds actually took in about $128 million, third consecutive week they've taken in money, and it's the third week in four they've been on plus side returns, this time to the tune of 0.08%. High yield munis was the main attractor of money, taking in about $166 million, and that would put single states and the other areas in the negative territory. We won't go classification by classification with that at all. Let's turn our attentions now to money market funds. Money market funds for the fifth consecutive week actually saw inflows, and this is to the tune of $3 billion. And taxable money market funds took in about $1.1 billion, while tax-exempt money market funds took in about $1.9 billion. Now, there was quite a dichotomy, though, between flows in the taxable money market side. Institutional investors put money to work back in money market funds, about $4.3 billion, while the retail investor took out about $3.2 billion. Well, we'll obviously keep an eye on some of the volatility that's been going on. Everybody's eyes are on the discussions between China and the United States, on keeping an eye on oil prices, having to do with some of the embargoes that are going on between Iran and possibly Venezuela, so we'll keep an eye on that. But we do want to take this moment to wish all our U.S. clients a very enjoyable, memorable Memorial Day weekend, a long 3-day weekend coming up, and we look forward to talking to you guys next week on Wednesday when one of our analysts will cover the flows for that day. If you want to do a deeper dive in the interim, you can go to www.lipperusfundflows.com and do a deeper dive, and if not, we'll see you next week. Thanks for joining us. My name's Tom Roseen, wishing you the best in your wealth planning and creation.